What are small finance banks? They're offering very good interest rates. Are they safe? We'll find out the answer to these questions in this video. Kindly watch it till the very end. In the Union Budget of 2014, issuing licenses to differentiated or niche segment banks that would specifically cater to the underbanked loan to MSMEs, to retail agri, microfinance. Basis that government's intent, RBI in July 2014 came out with a draft guidelines. November 2014, RBI came out with the final guidelines. January 2015, RBI published a list of 72 applicants. Out of them, only 10 entities got the license in 2015 August. Out of those 10 banks, 8 banks were microfinance entities. Now, it made a lot of sense for them to have a banking license because one of the biggest benefit why everyone wants a banking license is because it gives access to low cost deposits. What's that supposed to mean? It's only banks who can accept demand deposits in our country. Demand deposit means current account where zero interest is given and savings account where only a minimal interest is given. You obtain the funds at such a low cost, lend them, and then keep a good profit margin. It's that one capital local area bank, which is based out of 5 districts of Punjab, and then AU Finance Company, which was a non-banking finance company, which got a license to now become a bank and accept demand deposits. After the licenses were issued and the guidelines given, there have been two major changes in the guidelines. One was in 2019, wherein the concept of on-tap license was introduced. On-tap license means that people could apply anytime for a small finance bank license rather than a window being opened by RBI. Plus, the minimum paid up capital required to open a small finance bank was raised from 100 crores to 200 crores. Other modifications were also made in March 2020. Who can be the promoter of small finance banks? A lot of restrictions. First, in case it's an individual or a professional, they need to have a experience at a senior position of more than 10 years in banking and finance sector. In case it's a company or society, in that case, they need to have a track record of 5 years and they should be found fit and proper. Fit and proper means that RBI should be satisfied that they have the highest level of integrity, there are no financial issues with them, and it's a sound, fit and proper organization to start a bank. You would not want some crooks to collect people's money. Promoters had to bring in about 40% of the paid up capital of a bank and lock into 5 years. Up to 10 years, they have to bring down their capital contribution to 30% and then within 12 years to 26%. Some lesson RBI learned from Kotak Mahindra Bank where the promoter equity was very high. He forced Uday Kotak to reduce it to 26%. Promoters have to ensure that there is a proper ring fencing between their other businesses and the business of banking. Ring fencing means that there should be a clear demarcation that this is my banking business, this is my other business. Once a small finance bank reaches a net worth of 500 crores, they have to get themselves listed in the stock exchange. That means the more diversification of owners. So these were the guidelines, very strict guidelines when it comes to promoters. Even to apply for a license, you need to follow all these guidelines. Next part, regulations. So they come under Banking Regulation Act 1949. They also come under FEMA, Payment System and Settlements Act. They're also covered under Deposit Insurance Credit Guarantee Scheme, DIGC, to 5 lakh rupees of depositors' money, just like any other bank. They also are required to maintain reserve ratio, that is cash reserve ratio and statutory liquidity ratio, has to be registered in the form of public limited company. So it cannot be a partnership firm or a proprietorship firm. Now let's discuss scope of business for small finance bank. The primary objective is to do basic banking, which is accepting deposits and lending. Secondly, because it's supposed to be for the purpose of financial inclusion, 25% of its branches have to be in unbanked rural locations. Also, there are certain priority sector norms. Please refer to my video to understand what is priority sector norms. Unlike other scheduled banks, where 40% of their adjusted net bank credit have to go towards the 8 sectors that form part of priority sector lendings, in case of small finance banks, 75% has to go to these 8 sectors, such as agri, MSME, export credit, housing, education, renewable energy, weaker section loans. 50% of their loan portfolio should have loans which are less than 25 lakh rupees. That means they should concentrate on small retail loans rather than very big wholesale loans. They cannot open a subsidiary. Like, for example, there are a lot of financial services that banks cannot offer, such as banks cannot be insurance companies, they cannot be mutual fund companies, they cannot be in the broking business. So many of the banks, they have their subsidiaries such as SBI Mutual Fund or HDFC Securities Limited. They can appoint bank correspondents, but they themselves cannot be bank correspondents for other bank. They will get authorized dealer category 2 license from RBI. Kindly refer to my video on foreign exchange, which I have covered this particular aspect, what is AD1 and AD2. They can also be distributors of mutual fund, insurance, pension products, like that, where basically banks' own capital is not at risk. It's a distributory function. Earlier, RBI approval was required. Now, in 2020 modification that came out, in that RBI approval is not already in the business and small finance bank business for 3 years. Now, let's address the elephant in the room. They are offering very good interest rates. So, are they safe? My answer: yes, of course they are safe. First of all, they come under the direct supervision of Reserve Bank of India to maintain CRR, SLR deposits. Besides that, their capital adequacy ratio, CAR, that they have to maintain against the various risks that banks have, credit risk, market risk, and operations risk, is 15%, 15%, which is pretty high. There are a lot of other guidelines that RBI has put up. Loan cannot be given to promoters or their relatives. The exposure to one single entity for investments cannot be 15% of the paid up capital. It's not that you collect money from the depositors and then invest in some other company. The lending cannot be more than 10% to a single entity or a group of entities. Anyways, 50% of their portfolio has to be up to 25 lakh rupees of loan only. Other than promoters, no individual, including individuals and relatives or entities, can have more than 10% of the shareholding in a bank. If the shareholding is very high, they may apply a undue pressure. Majority of the board directors have to be independent directors. Also, while applying for the license with RBI, they also had to submit a technology plan. How do they plan to manage the data security and other risks which are there in the banking industry today because of technology issues? Of course, the purpose of small finance banks is to have a wider financial inclusion. In India, thanks to Jan Dhan Yojana, about 75% of our adult population now have a bank account. However, when you look at other products and services, we are still highly underpenetrated. Our retail credit is just 12% of the GDP. Compare that to USA, where it is 76% and 88% in UK. Mutual fund insurance, we are way behind other developed nations. So long way to go, and small finance banks hopefully help our country to increase our banking penetration. They can be nice neighborhood banks which come under the direct supervision of a very strict and a good regulator, that is Reserve Bank of India. I hope you found today's session useful. Please do like and do comment and let me know how did you find this session. And do not forget to subscribe so that you keep getting update on banking and finance from my side. Thank you.